We're going to call this meeting to order here at 7:03. Welcome. We have the recording going. Sounds like the recording. Everyone, welcome to the May 26th meeting of the JRIB. I am excited to say I think this will be our last WebEx meeting. And now that we're able to have in-person meetings back in June, stay tuned. We'll get some details, but I think this one will be will be one for the books. And so in proper form, this should be a quick and tidy kind of meeting. We don't have a lot to go through, but we're just going to let's just power through where we're at. Before we begin, I'd like to introduce to you all our newest board member. Susan Bala has graciously accepted the opportunity to join us as a town representative. Susan, would you mind taking a moment or two just to kind of give us a hello and kind of give a sense of where you are and what you do for the town?
Sure. I've been a Fairfield resident for 37 years. I've been with the town full-time for 23 years and about 8 years part-time before that. I started as a paraprofessional at the Roger Ludlow Middle School. My first year it was in
driving me crazy.
And then I started working full-time at the Fairfield Woods Branch Library, and now I am the senior circulation coordinator at the main library.
All right, welcome aboard.
Thank you.
You know, hope you enjoy your time serving with us. Guys, I'd like to move in the agenda to look at the minutes from the April 28th and then the May 4th special meeting. If I could ask someone to make a motion, if you want to, not even sure if everyone's taken a moment to review them. If you want to take a moment and sit down and read through them if you haven't, if I could ask someone to make a motion when you're ready. So if we want to discuss, I'd ask someone if you could make the motion and we'll second the motion and then we'll talk about any changes.
A motion to accept.
Okay, Tom McCarthy has made the motion. Do we have a second? Jared Schmidt, a second. Okay, so let's open this up. I have one typo in the first set of minutes for the April 28th, and it's a funny one. Toward the end of the second page, Tom McCarthy, your first name is spelled Town McCarthy. And while I know that you can you can do a lot, I don't think you're a town. So I might ask that we just amend the spelling of his name.
It wasn't helping my messianic complex.
So other than that, does anyone have any changes they'd like to make or for the minutes? All right, hearing none. All in favor to approve the 2 minutes, say aye. Raise your hand. Aye.
Aye.
Everyone? Okay. No, any objection? Nope. Abstain. Susan, will you be abstaining?
Yes.
Susan Bala abstains. Okay, terrific, guys. We're going to move on to our next item here, item 3 on the agenda, and that's to introduce Milliman, our new board JRIB actuary. Jen Castellano is here with us tonight. Guys, as a preface, I just want to say I am so grateful to you and thankful to you through the whole process as the board, and then the town really expedited this through, and it made it through the Board of Selectmen meeting at the last meeting last week. And so we are approved, I think, pending a couple last minute details to the contracts. I think we're there. So with that, we've asked Jen to come tonight and kind of refresh us a little bit, welcome her, and perhaps spend a minute or two helping us understand what the transition will look like, and maybe a couple minutes Q&A. Jen, please.
Sure, thank you. Thank you for having me here tonight. I am, on behalf of Milliman, we're looking forward to working with all of you moving forward. With respect to the transition, if we do everything that we're supposed to do, it should be fairly seamless for all of you and for the town. We have already provided the town with the standard transition request to request the data that was used for the last valuations. That will be sent to your prior actuary. It's standard, it's expected, it's run of the mill. So once that's been sent to them, I don't know if it's been sent yet, but once it has been sent, we will receive that information directly from them. And what our first step is to replicate your last valuations. So you've had your July 1st, 2020 valuation reports completed. We're going to perform those independently and try to match the numbers so that we're as close as possible to where you currently are. And we will work with your prior actuary to figure out any discrepancies that we may come across, and any understandings that are not necessarily clear in the report. And that's the first step. So that's what we're going to be busy once that contract is signed and ready to go. We're going to be running, hitting the ground running on that. Meanwhile, towards the end of this month, we'll be sending out data requests for the pension plans, since you're on even years for the OPEB plan, so that we don't have to worry about performing those valuations this upcoming cycle. But we'll send out data requests for the pension plans to the appropriate parties to provide the updated census data as of July 1st, 2021. Our data request, we've recently revamped it, and we've made it kind of interactive so that it prompts the user, whoever is filling out the information, it prompts them for the information that's pertinent to any change. So if someone's status changes, it prompts them to provide the other additional information. The purpose of the request is so that once we get the data back from that person who prepares it, that it is complete, and we won't have to spend a lot of time going back and forth asking questions. That's the goal. That's the intention. So really, resources on your side, and on the town's HR side, in the short term is not much. We'll be requesting copies of the most recent valuations, copies of any plan documents or SPDs, summary plan descriptions. And then depending on whether or not we're going to be performing ad hoc benefit calculations in the meantime, we'll need just copies of what participants are used to getting so that we can keep that seamless for participant experience. But it's pretty standard, pretty straightforward. We've worked with Hooker and Holcomb on this process several times in the last few years, so and it's always gone pretty smoothly. So I don't foresee too much anything out of the ordinary. With that, I'll open up to any questions anyone may have.
Walter?
Hi, can you hear me?
Yep.
Several members of the police department purchased their time from the military so they can retire early. But the forms that they were receiving from Hooker and Holcomb were not showing that, reflecting what they would get going if they retired early. Would your firm be able to do that? Maybe I can explain it.
So when they go to retire, they're not the forms
Yeah,
not reflecting that?
if you serve in the military for up to 4 years,
Mhm.
your first 2 years here in Fairfield, you're allowed to buy those up to those 4 years. You have to serve at least 25 years here in Fairfield. Therefore, you can retire with 29 years of service.
Mhm.
But the forms that we receive every year don't reflect what you would get. It only shows up to 25 years, and it confuses some of the guys. I keep telling them, don't worry, you're going to get your 29 years if you do your 25, or 26, you're going to get 30. But it doesn't show that on the papers, and they every year they ask me.
Okay, yeah, so that's something I'll make a note so that when we collect data that we know who those people are who have purchased the service.
Absolutely, I can help you with that.
So we can incorporate that into, and we'll work with the HR department and whoever is providing that information to make sure that we incorporate that into you're talking about your annual statements.
Yes, correct.
Yes.
Thank you.
We'll definitely, I'll make a note.
Okay, any other questions? Okay, Jen, I have one. we have coming up scheduled for our July meeting, the end of July, July 28th, a discussion and possible vote on our discount rate.
Mhm.
And ahead of that, I'd really like to be able to distribute at the June meeting, kind of a comparative analysis of the towns around, who uses what rates, and kind of thoughts of what that could look like. Anything that can help us with ample advance time to be able to sit and reflect on, you know, who's doing what, to get as prepared as we can.
Sure. Yeah, we can certainly put that together for you, and give you a kind of a peer review analysis of your surrounding towns, surrounding communities, what
Great.
they're doing.
Okay, and I'm quite certain that, you know, that information too, we'll want to be able to circulate that information to the Board of Finance, to the appropriate people in the town.
Mhm.
It's always a hot topic. So,
Right, right. And I would imagine, you know, in the July meeting, you'd wanted to have discussions with some actual quantitative analysis around what the impact of making those changes would be on the contribution. I Depending on the timing of receiving data from Hooker and Holcomb and whatnot, we may or may not have the replications done in time to be able to do that. But what we can do, if that's not the case, we can base it off of the valuations that have already been performed by Hooker and Holcomb. We can project it forward actuarially and use the sensitivity analysis that's provided in the GASB reports around the discount rate, the sensitivity to the discount rate changes. And we can provide you with some approximations just to give you an idea, ballpark of where the numbers will move if you say lower your discount rate by 25 basis points or what have you. That way you can have some more information to make a better informed decision, have a better discussion around that.
okay, I'd love to talk to you about that further as we get closer to
Sure.
it,
Yeah.
because we're going to need that quantitative information. And
Yes.
if it's something we hold over and we use, you know, Hooker and Holcomb because they have the valuation, you know, just walk me through how we do that,
Yep.
given the timing.
Yeah, we'll see where we stand with the replications, and you know, it all depends on when we get the information,
Okay.
for us to turn it around as quickly as we can.
So our goal would be to have any type of quantitative analysis kind of ready to go with maybe 2 weeks advance notice ahead of the meeting.
Okay.
Right? So we can get that around and socialize that with where that needs to go. So no one feels that they're surprised.
Right.
Okay. That's what I have. Does anyone else have any thoughts or comments or questions? Chris?
Maybe it's more for just in general. What is the actuary's contact at the town side, and how do they, you know, if there's any issues that need to become, how do they contact the board and let them know what's going on?
What, I'm not sure I understand the question. I guess it would depend on, from the town side, it would
Well,
depend what the topic is. You know, if it's a benefits related issue, then it'd probably be HR. If it has something to do with, you know, what goes into our annual report, the disclosure, that would probably come through the finance department, either myself or Caitlin.
Okay, I mean, I'm just saying.
Does that answer your question?
Well, I was saying if we have concerns, we do have a kind of a tight timeline. If we're going to try and get some information for our upcoming meetings, next 2 meetings, if there anything that would sidetrack that, we would like to be known as, you know, how would we know as soon as possible to get that, sure that there's smooth that as possible.
Yep. And we talk a lot, Chris, too. So I think, and you know, Jen and I will be in conversation too, as far as getting information for the JRIB.
Okay.
Right? Unless there's a better way that you like to work at Milliman that you find is
No,
the best
we're-
practice.
We're open to whatever works for you. We're flexible. We kind of take direction from how you like to work. You know, every entity is a little different, so we understand that.
Okay. All right.
I have a quick question. Jen, who have been in contact with us thus far on the town side?
I believe Becky's only been working with Gerald Foley just with respect to sending the contract, the sample contract to be looked at by the town's attorneys, and sending the transition data request to him so that can be passed along to Hooker and Holcomb.
Okay.
I don't believe we've been in contact with anyone else directly. far as I know.
I have not spoken with her yet. I don't know if I don't think Jim Hazelkamp has yet. I think it has just been Gerald until the transition is complete, and not the transition, but until the agreement is finalized. And then we'll start opening it up to myself and Jim.
Yeah, I'd be happy once the contract is taken care of to sit down with the appropriate parties and then, figure out the next steps and how to move forward.
Yeah, definitely. I'm looking forward to it too.
Right. The reason I brought it up, of course, was some comments that had been made just given the fact there's some transition going on right now, which have placed some strains on resources and making, just having the arms and legs to get all that needs to be done. I just want to, again, call, make sure we're all aware and sensitive to that.
Mm-hmm.
Nothing else.
Yep, very much so, Tom. I think we're acutely aware, and very, very sensitive to it. But next step is to make sure those contracts are actually finalized and signed. And of course, as we discussed, right, I think we're all in agreement, as we discussed, that if their period of time is required, that kind of we slow walk the transition, we will. Oh my gosh, this is comical. All right, any final questions? All right, Jen, thank you very much. Congratulations. Welcome to Fairfield. We hope you like
Thank you.
working with us. Thanks for coming to Fairfield when we're in person again, without musical accompaniment.
I look forward to it.
Thanks,
Thank you very
Jen.
much.
Looking forward to it.
I'll be in touch. My send off.
Okay. Wow. Let's move on, guys, to item number 4 on the agenda. So the alternative assets, guys, this was the topic that we spent the last couple meetings addressing our alternatives, namely our private equity exposure. I wanted to kind of provide an opportunity just for us to discuss that. I want to introduce Jack Mahoney into the conversation, who was kind enough to offer to kind of follow up with Mesereau and Lexington just to ask more questions about their open products. And Jack, if you're with us, if you don't mind, would you be willing to kind of share with us what you picked up along the way, just to kick off the conversation? Oh, Jack? Looks like he's. Oh, he was here. It looks like he dropped off. I don't have the details that he had. I can tell you guys that he did follow up both with Lexington and Mesereau. They're in the process of gathering assets to do a close later this year, each on new funds, and they're willing to provide information to us about those funds, more detail, if we would like to have more detail. I will kind of kick this off. The thing I noticed from those presentations was, kind of what a nice diversifier it is for us, how important private equity is in our mix. And as we move into kind of receiving distributions from our previous investments in private equity, that's going to take our allocation to private equity down below to a level that's below our asset allocation target. And so the question I'd like to pose is, are you comfortable, would you be comfortable with making an additional investment into private equity? Are you more comfortable having the allocation kind of drift down as distributions? And any thoughts about whether or not you'd like to stick with, invest into Lexington Mesereau, or look at other products, including Brian Binkley's here with us, and he's presented to us HarborVest. And so that, of course, is an option. I just love to kind of open it up for a couple of minutes of just open discussion. Anyone have thoughts?
Carolyn, are we talking about maintaining our allocation and, investing into new fund to maintain allocation? Or are we talking about increasing the allocation to private equity?
No, this is to maintain the allocation. At this
Oh,
point, I think it's to maintain the allocation. There might have to be some math done, right? We might have to do a little calculation of what the distributions will look like versus the new funds to go in, what that means. But in my mind, I was thinking to maintain the allocation.
I'm in favor of maintaining the allocation, whether it's, one of the existing funds or another. I think it would be helpful to have some kind of comparison, but I'm in favor of maintaining the allocation.
I would like to add that, by maintaining or moving forward, like making additional investments into the asset class, we're going to hit different vintages. So like this new stuff will be going forward. We have stuff that's getting aged from the previous thing. So I think you want to sort of, when you make the investments, you do it consistently so that you don't have, periods of time where we're in private equity, we're making good returns, and then we take years off and not making it, and it bleeds down. So you want to definitely be consistent going forward, and obviously continue with the allocation, whether it's the current allocation, increase it. It brings, it's a long-term asset class, and the pension fund is a long-term thing, and we need to really grow the assets to reduce the unfunded liability over time. So I'd be supporting it.
And just a question, didn't we have that mapped out for us at one point? Didn't we have the kind of, I thought that we may have had a slide or two on the distributions and how they were coming offline and how it would feed another fund, and maybe we can put a plan together like that.
Eric, this is Brian at Vanguard, Brian Binkley, since Brian Scott's here as well. But yes, we have done some cash flow analysis or some pacing, and to look at, how that would draw down over time and what type of investments you would need in order to keep that 5%. Eric Newman brings up a good point is in order to do that, is for it not to be lumpy. One thing that we advocate for is really subscribing on a regular basis, so it spreads out. That it's just along the lines of diversification. Again, your vintages, which is the year you invest, it's gonna differ from when you're in a hot economy or a recession, like it was a quick one we came out of. So we can help with that pacing as far as understanding the distributions that are expected. I mean, they could always change, and then also what kind of contributions are needed to keep that target as close to a constant as you can. And I think at the last meeting, we did some analysis where we just no new investments. Right now, we're slightly over the 5% target. And I think Brian can correct me. I think it was the end of next year with no new investments, then that allocation would start to drift down because we're receiving distributions. Your biggest investment was really back in what would be referred to as the 2013 vintage. Was 25 million. It was 15 to Mesereau and 10 to Lexington. There was a follow-on in 2017, but that was at a smaller amount, a 7 million in total. So there's some information about where you are in the presentation this evening that we provide regularly. We didn't provide the pacing or the cash flow modeling in this presentation, but we can do that again for you.
Brian, you were spot on with what you said. So in 2024 is when we estimate that the town will dip below the 5% target allocation. And just so the town knows, when we're modeling that out, we're assuming assets grow at 2% per year, which is pretty conservative. So over the next 10 years, you're looking at an average target allocation of about 25 million. So right now, as Brian pointed out, you're over, but we anticipate Mesereau, starting the NAV of Mesereau starting to draw down through distributions over the next 3 years, and that's what's really going to drive the decrease or dip below the target allocation. And then with that, to Eric Newman's point, pacing. I think last presentation we showed the committee the J curve or the net cash flows for the current private equity lineup that you have. These funds take a few years to build up at NAV. So the first fund to fund is typically the first 3 years when investments are being made. So even if the town made an investment today or made a commitment today to Mesereau, Lexington, or HarborVest, you still might dip below your target allocation because it will take a few years for that position to start to build up.
Another question that's on that I'd like to kind of pose, and we can come back next month and really take a look at kind of what those numbers look like. But the question is, are you comfortable with just having as options continuing with Lexington, Mesereau, and then we can also look at HarborVest if you like. Does anyone have a burning desire to look beyond that? Do you feel comfortable with what we've got? Because that's a longer, bigger process. And without Callan anymore, we would be doing that kind of on our own, because Vanguard will have to leave us at the HarborVest edge, if you will.
Yeah, and just to provide some context on that, as far as when Vanguard was moving into private equity, which we did last year, that was the first announcement and the first fund that we raised and I did include just a slide on this, and we would have covered it last year, but our manager research team, did go out and meet with numerous, would be on slide 25 of the deck, but we did qualitative due diligence on over 45 private equity firms, and then deep dives with 11. We narrowed it down to 2, and then we selected HarborVest. And as far as our partner, so Vanguard, of course, is not managing the private equity fund. This is done by HarborVest, and for numerous reasons, which I'm glad to go into again, we thought that they were the best long-term partner for our investors based on their years of doing it and their access to some of the best general partners out there, and then just the size of their team as well.
So unless you guys have strong feelings otherwise, and I'm sorry that Jack dropped off, he was with us earlier. Would you be, I'm assuming we're okay if we kind of come back with some quantitative kind of a sense of what the numbers would be, what the allocation would be, what that would look like in numbers, and whether it be Lexington, Mesereau, or HarborVest, that we kind of stick with those 3 as our options? See a lot of nodding heads. Okay.
I'm good with that.
We're good with that. Okay. Okay. I'd like to make a motion. I'll make a motion on that. So I'm gonna make a motion that. Can I make a motion if it's not on the agenda, or we just, Chris, are you with us? Oh.
You have a noted possible vote action.
Okay. So all right. Thank you. So I will make a motion that we will come forth to the board next month with an assessment for potential additional investment into Lexington, Mesereau, and look at a fresh investment into HarborVest. Someone like to second that?
Second that.
Tom McCarthy. Okay. All in favor? Aye.
Aye.
Any objections? Seeing none, no abstain. Okay. All right. So that's what we'll do. We'll come back and we'll do that for the agenda next month. Okay. Brian, you good on that?
Sure. Yeah, good. Thanks, Carolyn. Yes. And so what Vanguard will be prepared with is we'll set out, we'll just update that pacing to show what kind of, how much of investment you would need despite fund in order to keep that target allocation. And there's a lot of variables. Brian hit on another one, is what happens with the overall size of the pension, right? Do we get more appreciation than expected? does it dip down at some point? Of course we have volatility. So we'll work with that and update that analysis for the June meeting
Right.
to include. And then just one point to make, and I'm sure Jack's aware of this and maybe others are, is the difference in the Mesero and the Lexington funds is the Mesero is a little bit what we would say is more diversified. It includes both primary and secondary investments, whereas the 3 Lexington funds that were invested in the past were only secondaries. So again, secondaries is you're buying someone else's private equity stake that they're liquidating for any host of reasons. And when we think about private equity, just like any other investment, diversification is such a big benefit. And not just diversification by vintage, which we've talked about and which the town has followed, but there's diversification from those types of private equity investments, primaries, secondaries, and then there's a third, which is referred to as co-investments. But just wanted to put that out there.
All right, thank you. All right, guys. Thanks. All right, moving right along. Brian, you need me to share my screen, right?
Yeah, I guess I haven't. I learned I haven't been following Vanguard security protocol, and I was sharing my screen when I should not have been. So hopefully everyone has the presentation. But thanks for driving, which maybe is just one more meeting, Carolyn.
Yeah, I gotta tell you guys, I'm so tired of sitting in this room in my office. I'm ready to bust out. Let me see if we can get this.
I'm bringing the candy.
I'm gonna try to open this in a Google Doc. Let's see, it's coming. Yeah. See, it's thinking.
Yeah. You can just go to page 2.
Yeah, it doesn't have the Let me see if I can try again, guys, with the open this as PowerPoint. Sorry about that. And let's go to 100. All right, can everyone see my screen?
Yes.
Yes.
Okay, page 2, here we go.
Okay.
All right,
Oh, sorry.
I'm on
Let's
4.
go. Yeah, let's go to 4. Thanks, Carolyn.
4.
Yeah, 4. And good evening again, everyone. Good to be with you. We're going to keep it high level, review performance. We've done that each and every month. We'll give you an update through the end of April. And please always interject with any questions, even if it's not on what I'm specifically talking to. So love making the interactive and getting questions from the committee. So let me just start with a quick recap of April. The April numbers I'm going to cite are not on the page, but I'll focus on the other time frames. So April wasn't, markets continue to climb, at least on the equity side, but also in fixed income. So in the month of April, the total U.S. stock market index was up over 5%. The international markets were up over 3%. And even the fixed income markets, the U.S. fixed income markets, the Barclay Ag was just up 0.8%. So what that led to, and then this is on the page, is if you're just looking at a year-to-date return, just is continue to bolster the absolute return. So on a total U.S. market, we're up over 11% year-to-date. This is calendar year-to-date. International stocks still lagging a little bit, but still up a respectable up over 7.1%. And something we've talked about before, with the rise in interest rates that we've seen this year. So we've had weakness in fixed income. That's in the middle of the page. So US fixed income is down 2.5%. That's that middle column. And non-US bonds, which you also hold, down 2.4%. So just 10 basis points higher. Page 5, Carolyn, next page. I'm not going to spend here, but this just shows you, well, I'll spend just a moment since I brought it up, is the rise in interest rates, which relates to the fixed income performance, what I just referred to. So if you look at the dark blue line, really you could see it's those longer dated fixed income, like commonly referred to as the 10-year treasury rate moving up. it's been up over 79 basis points in a 1-year time frame. The 3, the 6, that's held by the Fed, and of course the Fed's holding interest rates close to zero, and still the expectation, despite everything that's going on in the economy, is that we won't see a rate increase before 2023. So that brings us to the town's performance. We'll start with the pension. And starting with the pension here, so for the 1 month, the pension plan was up over 2.5%, the top line. But very strong. If I move to longer periods, the fiscal year to date, this even improved from the last month, given what rolled off. So fiscal year to date, we're up 21.25%, with a couple more months to go in your year, slightly above the composite benchmark of 21.7. And then the 1-year number even stronger at 26.47%. So we hope that continues, of course. Looking at the bottom of the page shows the current asset allocation as of the end of April versus our policy targets, and whether it's at the total asset class of equities or fixed income or the sub-asset classes, we are all within tolerance. To give you an update on some cash flows, at the beginning of May, our monthly distribution was just rounding 2.4 million out. That's why we have that cash allocation. That's always temporary. We raise those funds towards the end of the month. We work with Peoples on that. And then Jared and Caitlin as far as getting signatures. But that cash is not held throughout the month. And we just raised some additional cash at the end of this month for the May payment that's going out June 1st, and that's in the amount of 2.2 million. The last thing I'll just hit on that's not on the page as far as distributions that we're talking about, we did get a distribution that was paid today from the Lexington 6 Fund in the amount of 375,000. Anytime we have cash flows, just to note, let the committee know, we look at those cash flows, we look at where your asset allocation is in respect to your policy target, and we use those cash flows as a first line of defense to rebalance to those targets. Okay, Carol, I'll have you page forward, and I'll go past the page that you're on, because it's the index funds for the two, for the 2 stock funds and the 2 bond funds, which really mirror the performance I just talked about at the beginning of the presentation. The private equity returns we update, if you recall, in a quarter lag, so we won't update this till the end of June with the first quarter valuations. But I'll just touch on the real estate. I did get some data recently from Principal. It's not updated here because it's not audited, but I'll give you just a look into the first quarter of the year. So the first quarter of the year, again, unofficial from Principal, is the real estate market, as we've seen in the economy opening. We've seen some good returns in real estate. So looks like they're up about 3.38% in the first quarter, which is over the benchmark, which is the NFI Odyssey of 2.11%. So again, those are preliminary. We'll update those another month or two, but I just wanted to give you some sense of the rebound that we're even seeing in the real estate markets. The other update I just have with respects to Principal is in the fund is that they've had they had contributions into the fund of 113 million, and that eliminated the inbound queue they had from investors, which was on hold, that was suspended since the beginning of the pandemic. So they took in new assets into the fund, and they're also paid out redemptions. So there's nothing else to be paid except any new redemptions that come in, which were only 11.6 million that'll be paid in July. So, they suspended some of the redemptions during that really tough period of the pandemic. So I just wanted to give you a little color on the real estate market. Page 9, we always include this. This just shows what your commitments were to each of the funds, kind of where we are, how much was remaining in our commitments, and we update that for on a quarterly basis. This will tie into what we discussed next month as well. So I'll jump to the next page, which is just looking at the OPEB performance. Just as a reminder, there's heavier weighting to equities. This is a 70% equities, 30% split between fixed income and real estate. We have a 10% real estate allocation. So because of the more aggressive allocation, the returns, not surprisingly, were stronger than the pension. So on a fiscal year to date, what you're looking at is the OPEB is up 27.08% and a 1-year return of 34.8%. So very strong returns given to the more aggressive allocation. Still appropriate for a long-term pool like this. So I don't want to give the impression that it's not. Also on the bottom of the page, we don't have as much here by way of cash flows. So we continue to monitor that, but we're getting close to some rebalance targets, more in the fire and police account. But right now, no rebalancing going on. Yeah, that's it. One thing, if you go to page 15, this will tie into Carolyn and what you discussed with Milliman, and we'll continue to work with Milliman and any actuary in setting those long-term required rate of returns. So this will just give you a sense, looking at your current policy targets. Right now, this is using our 12/30 forecast. Our first quarter capital market assumptions just came out this week, so we'll refresh this for the next meeting. But towards the middle of the page, this would be the numbers that to focus on, or what Milliman would focus on. At the median, or the 50th percentile, given the current asset allocation, we're looking at over 30-year time frame, 6.15%. But we always think of any returns in the distribution. At the 75th percentile, you could see that's 6.83%. I know the required rate of return right now is at 7. So, that puts it, on the more aggressive side of our allocations, really outside of that band. We'll refresh that with 1Q data. I don't know if it'll change dramatically since they are such a long-term forecast, but I did want to give the committee just a look at that ahead of the June, July meetings.
So another way of looking at this, Brian, if I'm getting this right, is, effectively, if we were to use your targets and run through, if we're a 75th percentile performer, right, our implied rate of return, annual rate of return is 6.83%, and that's against our target rate of return of 7%, which is also known as the discount rate.
Right. So the discount rate, being above that 6.8%, think of it as kind of a 25% likelihood we get 6.8, only a 5% likelihood we hit 7.8, in the tails. So it's just aggressive. All public plans are kind of wrestling with this and been slowly, no dramatic moves, but slowly reducing discount rates, because the capital market forecasts, this is not unique to Vanguard, have been coming down. It's been coming down because of how well equities have done, and also because of where we are in the fixed income markets with rates so low, and it's harder to get return. That diverges, but it certainly ties into private equity allocations. You see public funds and others going more into the private asset classes because the return expectations are higher. So for instance, let me just focus on that. Towards the top of the page, you see the 6 asset classes that we have. And then to the right of it, the far right, those are the forecasts that we have for each of the asset classes. So for instance, our estimate for the next 30 years for private equity would be a return of around 10.5%. And you could see that's much higher than just US equities or non-US equities. And I'm talking about the 50th percentile. So this is probably the biggest question that public plans are wrestling with, is what to do with the discount rate. Of course, it's sensitive. As you change that, it might mean more in contributions. So absent, what are your tools? You can lower discount rates, or you can change asset allocation to make it a little bit more aggressive to reach that. We can do much more modeling for you on different asset allocations, similar to we did last year. But for instance, I just gave one, which I know there's no interest in increasing private equity. But let's just say you went to 10% private equity. It bumps it up at the median from 6.15 to 6.37. So it brings it up a little bit, given what our forecasts are. And then you see that 7% return target is within that 75th percentile of that band.
Interesting. Okay. Well,
so I just wanted to provide this for food for thought. It'll tie into discussions with Milliman in the future.
right. This is a great way to look at it. Actually, this is, as I'm looking at this slide, this is a very helpful way of looking at it. Where has our performance been? Do you know what percentile we've kind of we've been in on a historical basis?
No, I don't know where the percentile is. And again, think of this as just not as rankings, but this is the return distribution of the forecast.
Yep. Okay. Go ahead.
Yes. But, going back, if I flipped back, and the performance report is really going out 10 years. I'm sure we can get some more data, but your 10-year return for the pension plan is 7.44%. So you've certainly exceeded that return target, at least over the 10 years.
Right.
For the OPEB, the last 10-year returns was 7.89.
Yeah,
so slightly higher.
As we look at this, I'm just looking at this non-US bonds and the US bonds, and that the return profile is just expected return is so low, right? If we move into an environment where yields increase, right? Yields go up, bond prices go down, our portfolio will reflect that performance. And if we suffer some inflation, you kind of want to stay in equities and away from fixed income, at least for initial period of time. So we're really suffering because of the very low interest rate environment.
That's absolutely correct. As the Fed and central banks all across the world have pinned rates to zero and have held them there, that puts a lot of pressure. The fixed income assets don't work. So we want yields to rise. Maybe we'll get some short-term pain, like we see in the last 1 year with our fixed income portfolio. But remember, fixed income is providing that protection. We really want to see the higher yields to help the overall portfolio in the longer term. And totally agree with you, Carolyn, there's so much talk about inflation, but really over long periods of time, which we should be focused on, equities provides the best hedge against inflation over the long term.
Okay. Well, this is really good food for thought. This is a great way to present. Does anyone want to jump in? Any other comments on this page?
Our investment policy, right? We're going to be review it twice a year. Is that what we determined when we reviewed last time?
Twice a year.
Since some of these allocations, if we're going over, in a couple months down the road, we say, okay, chances are certain asset classes are going to continue growing, and we might want to adjust it every 6 months as we review them. And if even increasing some of the private equity right now, it's at 5%. If we keep going in that direction, we could always increase it, incremental over every couple time frame.
Yes, there's different levers that we can pull from an asset allocation perspective, whether it's what you mentioned, Eric, whether it's increasing the equity allocation. Something that we've talked about in the past is investing a little bit more weight in corporate investment grade bonds, but spreads are historically tight right now. So you are getting some incremental yield, but not much. We're close to all-time tights. So there are different levers. And, again, our approach is always to be focused on the long term, and we're not tactical. We don't believe that's a winning strategy, but looking at longer term, there's things that we can look at.
Do no harm.
Do no harm.
Mm-hmm.
I guess a question for Jared. With the budget, right? Do we front row fund the pension plans with come July 1 or that July August, or is it funded monthly, quarterly throughout the year? Because that'd be another source of cash flow into the funds, which then have to be, deployed into investments.
We've typically done it in September. The money goes in September.
That sounds right off of memory as far as last year. We, in my head, is more in that $5 or $6 million contribution range. We can go back and confirm that, but when we put that money to work right away, and for good reason, we've certainly benefited. We believe in being, in fully invested.
Well, we're certainly going to have some food for thought, guys, over the next 2 months, as we think a little more tactically with this information on the private equity piece next month, and then really what the right discount rate number should be.
Mm-hmm.
Which certainly seems to be a little bit lower than where it currently is.
And what I'll also say is this is something that we've shown in the past, just for comparison's sake. Brian has done some nice work in the past of looking at the towns within Fairfield County and just giving an idea of where they are from an asset allocation perspective and their discount rates. I mean, everyone has a different funded status, therefore everyone has a different asset allocation and return target, but we're happy to refresh that and give the committee a look.
That'd be great if we could see that next month. I think that will help us. What I'd really like to be able to do, Brian, is put together a packet for everyone that has kind of the relevant information, the comparables, give everyone a sense, and give everyone a good head start on it, and take this over, take it slowly and methodically, so we can really think it through. So in July, we're really prepared.
Mm-hmm. Yeah. And then what I always like to leave the committee with is, yes, you're well diversified. There's just on the equity and the fixed income side, there's just the 4 funds, and you could say just, but those are diversified across market cap by style. There's over 10,000 securities, so the plan is well diversified, both from an asset allocation and just at the sub asset class level too. So.
All right, thank you.
Of course, our pleasure.
All right, with that, guys, we're going to move forward here to item number 6. Jared, you're up. CFO report. I know this is a light month for you. I don't know if you have any quick comments.
Yeah, I did not submit a written report this month. There wasn't much to say other than the transfers were made, and rest assured that the pensioners will be receiving their checks because those transfers were made from the into the appropriate funds, into the town fund and into the fire and police. And as Brian said, it's just over 2.2 million. I believe was the number.
Yeah, that sounds right, Jared.
Yeah, about 2.27. So that's all. I'll be back again next month with a full written report and more. So.
All right. Old business, guys. I don't have anything. Does anyone want to? Okay.
Good.
Hearing nothing. New business. I just want to give you a heads up. I did the quarterly review with the Board of Finance last week. I was very excited to bring in our great performance numbers and show them off. You guys, give you guys the big round of applause. And I think our Board of Finance was shocked. I think they were happy, but they were more shocked at what the numbers look like. We've got one more month kind of before the fiscal year end closes, and they've got to go forward and start preparing for the CAFR and the GASB reports. But if all holds, right, Bitcoin doesn't totally blow it. Just kidding, just kidding. We should be in pretty good shape. There was one thing that came up that I just kind of want to alert you to, and that was a question about, and I asked this as a sincere question to those people who were here kind of before me. Was there any type of a philosophical thinking that with OPEB, if OPEB got to $50 million in asset, we would allocate away from equities? I am not aware that conversation ever happened at any of our JRIB meetings.
So being probably the longest sitting member of the JRIB here, I never remember any conversation like that, nor do I think that would even be palatable due to the long-term liability that you're trying to cover with the OPEB. So interesting point, but
okay,
there's never been any discussion I've never heard of before.
Right. And the other context too is, they're not through any fault, but they're very underfunded as well. So you really need higher equity, or what we would refer to as return-seeking asset classes, to help grow that funded status over time as well.
That was an older board, right? So, like in the past 2 years, since March of 2020, we have 5 new members on this board. So, to tie this board, the current board, to a previous policy, even if it is, this board could easily say, okay, we could change anything we want. And same thing with the Board of Finance. That board shifted over years too. So things that are legacy, things change, markets change, and the funding status. Obviously, we're going in the right direction. This past year has been very good, but there have been periods of times where the funds and the markets don't do as well as the past year. So just,
Carolyn, that's set in cash till it was exceeded $25 million. When I first got here, it was cash.
No.
Yes.
Wow. Well, you guys, I also took a fair bit of heat for the equity overweight in OPEB. Like, it's high, right? It's high. And those of us who've been doing this a really long time look at that and go, whoa, that's high. But when you see the returns you get in fixed income, right? That last slide in the Vanguard presentation, I'm very, I think it's, it's the right place to be. And that's what I spoke to at the Board of Finance. But
and that's why we, at one point, we had those bands, because I think that they get too narrow-minded on, hey, listen, it says 5% and you're at 6.5%. You got that difference, that delta of 1.5. And that's why we added those bands in there, because they started just constantly keying in on those. And it really is a band. It's got to be flexible. So
yeah. Well, I defended our decisions here to the best of my ability. But thank you for filling in the blanks. I think we're doing a really good job. Very grateful to all of you. That's all I have. Does anyone else have anything? All right. This is the quickest JRIB meeting in the books for the last WebEx one. With that, may I have a motion to adjourn?
No motion.
Town McCarthy. Second, Jared Schmidt. All right, guys. I know we're all in favor. Thank you all. Have a really nice month. Happy Memorial Day.
Thank you.
Same to you, Carolyn. We'll see you at the parade.
See you at the parade.